And today we have the pleasure to have Professor Burgeoning with us today, joining us for our Meet the Faculty. Professor Burgeoning is an assistant director in our finance department. His research really draws information from public market and provide inside information for future equities and option performance. So it's like a weather wizard who's predicting the future. He also is very much in like the fintech and how technology has impacted the financial market. He is a CFO license holder, as well as the advisor for our student managed investment fund and a Invest Institute on campus. So please welcome Professor Burgeoning. Professor Burgeoning, am I missing anything? And can you give us just a short introduction about yourself? Tell us a little more about yourself.
Of course, Natalie. Thank you for having me. Hi, everyone. Welcome to the webinar. I think we're getting a bit of an audio feedback, but looks like that's fixed. No, that's a very extensive and flattering biography. Thank you so much. I'm an assistant professor, not an assistant director, but otherwise I think you nailed everything. I do work with the Student Managed Fund. I advise the Investment Institute, and I teach some classes in addition to the Student Managed Fund on investments, derivatives, financial modeling, and generally I am very excited about quantitative methods in finance. That's also what most of my research is in. In fact, it's really hard to do research without a quantitative approach. But I think more and more that type of approach is also being adopted in the industry of finance. And that means that for students, I think there's a lot of value add in sort of picking up as much quantitative training as you can. Of course, there's some training that's sort of part of the boot camp, and there's a lot of electives, I think, that are really good to sort of build out a master's curriculum, but that's something that I strongly endorse.
So you mentioned that you teach 3 classes on the graduate level: portfolio management, financial modeling, and one other that I'm missing now.
Yeah, the other one's really exciting, actually. It's derivatives. Yes. So most of my work involves, just as you said, sort of forecasting, maybe probabilities of future events or value gain from some sort of corporate event like a merger or change in regulation. And really this can't be done without looking at derivatives and specifically options. But also I think options are really sort of having their heyday now in terms of the interest of market participants. Probably many of you have heard about these recent shenanigans that SoftBank was doing by buying massive amounts of call options on tech firms and actually therefore driving up their prices. Because one of the interesting things that you sort of learn in the derivatives class is how complex these instruments are and how much hedging is involved. So as a brief sort of anecdote, to hedge selling an option to someone like a SoftBank, the market maker has to buy shares of the company that they sold those call options on, which of course creates a feedback loop because call options appreciate with rises in the price of that firm. So for a while, SoftBank just kept buying call options. Market makers kept buying more stock in, Tesla and Apple and whatnot. And eventually the whole thing collapsed just a few days ago. But that's the sort of thing that I think makes people really interested in the power of derivatives. And that's the sort of thing that we cover in that class.
Very interesting. And that class seems very finance on a very professional level, geared towards for students who wanted to go into the financial industry. However, I know a lot of students whose background aren't finance, they are also interested in learning something about finance. And we always say that finance is in our daily life. So would you recommend any one of your class for students to take and what will kind of the everyday, like someone like me who kind of lack on the quantitative skill side, but will really benefit from one of your classes?
Well, so the financial modeling class is about essentially getting more out of Excel. It's still, of course, sort of related to finance problems, but it's more like, how do you discount cash flows? How do you set up a model to price a bond, optimize a portfolio? So it's maybe less narrowly focused, the way that the derivatives class is. But I think it's sort of, applicable to a variety of very practical finance solutions that still would add a lot of value in the workplace for a finance candidate. But, also I think all of us could benefit from a bit more spreadsheets in our daily life, simply because it is a nice way to organize data. So that one might be more sort of applicable to an even wider audience.
Thank you. And your research, like I just mentioned, focus on drawing information from public market and give predictions on the financial outcomes. So based on the information we have currently under this this pandemic, what kind of prediction can you make for the future, or what advice would you give for investors?
So, I mean, each of these, of course, would require its own sort of separate study. So in the past, I've done like a study of Obamacare when that was under consideration, and some specific merger events. And actually now I'm working on one of the Trump tax cuts that happened back in 2017. So unfortunately, these aren't exactly like nowcasts. They're not the sorts of things that one can immediately apply to current day problems. That require some data collection and then actually a fairly involved estimation. But as far as sort of things that derivatives can tell us about the future at any time, I think one of the sort of big dials on the dashboard, if you will, is the VIX, the volatility index, which essentially sort of tells you how expensive options on the S&P 500 are. And right now it's pretty high. So that can mean one of two things. Either it's gonna go way up and people are, again, betting on these call options that have positive bullish exposure, the way that SoftBank was doing on tech just a little bit ago. Or, and more often, it's actually the opposite, that people are now bidding more. They're willing to pay more for put options, which are essentially a bearish exposure. They gain value when the underlying, in this case the index, falls. So whenever the VIX goes to a level, let's say above 20, it's a sign that something is up. And now it being at, let me actually check, I think it was about 28, 28.79. That's pretty high up there. So it's definitely a warning sign. And of course, coupled with the news we've heard out of the Federal Reserve asking for more monetary stimulus, fiscal stimulus, it probably is more of a sign to worry than a sign that, there's going to be big future gains ahead. But of course, it's just sort of one indicator of many. And the cool thing about derivatives is sort of how broad of a dashboard they provide you, maybe with a bit more analysis. So please don't take this as investment advice, but sort of as a quick first pass, that would be something that I think is useful to keep in mind.
And speaking of investment, financial technology has now play a big role in the financial market and also on different financial institutions. And you're a big fan of fintech. So tell us a little bit more about how you think technology has impact the market.
Of course, if you can't tell by my background, I'm sort of an enthusiast of programming. It's impacted it in so many ways. If you look at what was going on in an exchange some 20 years ago, it really was what is still sort of portrayed as going on in an exchange, where it's people shouting at each other and waving tickets, but it isn't. It's just computers. Computers sending signals one to the other. And I think this sort of automation is really reaching out to other areas of finance, and that presents obviously a big challenge to all of us, because some tasks really can be replaced by a computer, and finance being sort of a very highly paid field is ripe for that type of disruption, because it would save a lot of money to replace human experts. But at the same time, of course, it's an opportunity, because if we can actually sort of build more of a quantitative portfolio within finance candidates, then that'll actually enable them to remain sort of human experts that can't be replaced. And I think sort of the great thing about finance is how much data it can actually generate. The market creates prices. I don't know how much actually data in terms of like terabytes of price data are created every day, but it's a tremendous amount. But even beyond that, there's things like fundamental firm data that's very easily digitized and accessible. There's conference call and other sort of speech data that actually, I think, particularly in finance, there's an effort sort of made to make that quantitatively analyzable. So given just how much data our field produces, there's a tremendous opportunity for data analysts to come in and use it sort of the way that, in maybe 50 years ago, an investigative journalist type of fundamental investor would have dived into fundamental disclosures. They would have gone through the balance sheet, the income statement. The thing is that now that all of those are so easily available, it really is sort of now incumbent on us to take the next step and start looking at the harder to analyze things, just as those reports were harder to analyze back then before the advent of computers. So that sort of goes back to my idea that the more quantitative background one can build, I think the better suited one will be to navigate this increasingly technological field, which is driven by just how much data there actually is to analyze.
And speaking of data available, and technology really also enables people who normally wouldn't jump into the financial market now participate in stock and trade. Now we have all these apps, Robinhood and some of the other apps really allows people to kind of test the water on their own. And I'm sure that also creates, like you said, a massive quantitative of investors now is new, and they're small, but if there's many of them, then they do also call for a large number of how you say, not inexperienced, but definitely not as experienced as somebody who is doing this as a profession. So how do you see that also affect the financial market?
Well, I mean, that's both, I think, an exciting thing and a disturbing development. The reason, I'll start with sort of what might be bad news. The last time this happened was in 2000, and we know how that story ended. And there are some similarities between what is going on now in the markets and what was going on in 2000 in terms of this really high optimism for tech, sort of tremendous price earnings multiples, and yes, sort of an enthusiasm specifically by retail investors. But of course, history doesn't necessarily repeat itself. As Mark Twain reputedly said, it rhymes. So it doesn't necessarily mean this is going to end in disaster, but the market being flooded with relatively less informed traders, and actually, interestingly, many of them trading options, is maybe a destabilizing force. Indeed, they were sort of documented to have contributed to this feedback effect in which SoftBank was involved, just because of, if you look at how much money SoftBank had invested in these call option buying strategies, the actual number of call options bought was vastly greater. So that means that somebody else was doing it. And of course, there may be other institutions, but the thought among practitioners is that this was also a retail wave. So that's maybe some of the danger. The solid benefit, and I think that's exactly what you said, Natalie, is that it does expose people to how the market functions. And of course, it causes them to build more, perhaps financial literacy than they would have had in earlier years when there were higher barriers to entry. But on the whole, the other thing that I would caution about is, Robinhood isn't necessarily the best trading platform. The reason that it's free is because they sell your order flow to God knows who. And there's other brokerages that are perhaps more reputable, but also now low cost. So I think there's sort of a gradation of approaches one can take to the market, from trading on your smartphone to trading on a computer. And there's a gradation of trading strategies that one could implement. Not everybody should be a high frequency trader. I think actually for sort of retail investors starting out, it may be better to start with something like the Warren Buffett type of long run, Graham intelligent investor type of buy and hold portfolio. But there is definitely a vast opportunity to try different strategies. And I think that is going to, in the end, result in a more sophisticated retail audience. The main question is how much sort of tuition are they going to pay in doing so, in terms of market losses.
That is some very good investment advice there. Now we're going to ask a professor about the two exciting organizations or you advise on campus. One is student managed investment fund. So for our students who are currently, for our audience who are currently not our current students, tell us a little more about the student managed fund. Are we using real money? What's going on, and how can students participate in the group?
Yeah, so the Student Managed Investment Fund, I think, is a great opportunity. It's actually a selective program that is both a class and an organization on campus. So students have to apply to join. And, we look for obviously high academic achievement, but also some record of financial investing experience, ideally. But it is open to graduates and undergraduates and really students of all disciplines if they sort of have the strong interest and ability to contribute. Here is the website for the Student Managed Fund. And there's two tracks. There's sort of the analyst stock picking track and the portfolio management, risk management track. I primarily focus on the portfolio management side. My colleague, Professor Hewson, focuses on the analyst side, but we work together. And at bottom, we manage about $1 million of real money using real strategies, both in terms of the selection of securities and the allocation of our capital to these securities. We use the Bloomberg platform, which I think is another really useful tool, especially again in these more quantitative times, being able to navigate the tremendous wealth of data that Bloomberg provides, and knowing how to use it for financial applications, I think is a big value add. And that's one thing that one would come away from an engagement with our managed fund with. But also just sort of, again, these best practices on investments, portfolio management, and actually a wealth of guest speakers who themselves are, of course, in the asset management field, and potentially a good network for jobs afterward. So one of my students in the portfolio management class, I was actually able to place with one of the guest speakers in my portfolio management class last spring. So he's now at Coast Capital, a local activist hedge fund. So there's, I think, a lot of benefit to be gained, both in terms of career and in terms of practical skills from engaging with this fund. And of course, it is just sort of really cool to see the results of your work in terms of how much you either improve or, well, hopefully not decrease performance of this $1 million investment.
That's definitely an exciting opportunity for students, because how many students can say, when I was an undergrad or when I was a graduate student, I'm already managing a $1 million fund. And also you advise a InvestNet institute on campus for students who are interested in becoming portfolio manager. So tell us a little more about that as well.
Definitely, this is another website that we have set up. So I'll put the link to that in chat. And this is actually an exciting new partnership between industry and where the asset management industry, or at least a group of asset management institutions led by InvestNet, which is sort of a actually innovator in the fintech space to provide infrastructure and solutions to wealth managers. They wanted to sort of create a better pipeline for job candidates. So it's an e-learning environment where they actually provide the coursework. Students that we select, well, I select internally from are then put forward about 25 per semester. So it's relatively selective to engage with this coursework. I, of course, get regular sort of performance reports on how everybody's doing. And then once the instructional part is complete, there's actually sort of a resume submission hub, a hiring pool, from which then the institutions actually hope to interview candidates for jobs. So this is, I think, another great opportunity to sort of pick up extra skills, build an extra sort of layer into your career network, as well as sort of show that you do have, this sort of competitive selection, because, this is a competitive process to get in.
And I see that we already have students asking a question on the Q&A, so I'm just going to throw my last questions to you, and then we will open the floor for students' questions. So I know a lot of the students who are also interested in gaining a CFA license after they graduate. So what advice do you have for those students who wanted to go sit in the test like right after they graduate, or in their time of being in the grad school?
I think the CFA charter is another great opportunity. It is less, super quantitative, but it is a very broad and very solid certification of sort of your familiarity with the core principles of finance, and it actually does range quite far. It will require you to learn accounting and derivatives, and of course, sort of investment, portfolio management stuff, but also ethics. It has, I think, a really sort of strong emphasis on portfolio management and either asset or wealth management applications. So if you have an interest in those types of careers in particular, I would strongly endorse it. But I think anybody who engages with the CFA program is going to come away the better for it. And I think that once you've sort of taken some accounting, investments, and maybe corporate finance or derivatives classes, one should be in a good position to take at least the first level of the CFA. And the nice thing about the exams is that you can actually say, you know, I passed the first level or I passed the second level. Even before you get to sort of call yourself a CFA charter holder, there are some sort of notches you can mark on your CV that do demonstrate a very serious commitment to sort of learning the details of finance that is required to pass these exams. These are 8-hour exams. There's 3 of them. The pass rate starts at about 50%, and it can be higher or lower for each. They take about, on average, about 3 years to complete all of them. So doing this is a big deal and therefore a very strong signal of the candidate's mastery of finance. So I think this is a great program to engage with. I found it really interesting even after I've passed the exams, because most large cities have a CFA society. So it's a great way to network with other finance professionals. They also have great guest speakers. Before this pandemic hit Miami, I actually was able to see at the last event at the Miami CFA Society, Rob Arnott from Research Affiliates, who's really one of the sort of giants of both academic and practical finance. So yeah, I think it's a great sort of enhancement to really all aspects of a financial professional's career, and I strongly endorse it.